Hello, everybody. I'm very happy to have you here in this new webinar of the ILEA series. And we have a very special guest today. And we'll be starting kind of a new part, if you want, of what the impact spectrum of what we are going to call later, and you're going to see the impact economy is. And we are going to start talking about ESG, environmental, social, and governance criteria, and how it is included in investment decisions, and how can this actually put some pressure, if you want, or how this framework affects corporates too. So we have a very special guest. We have Jaume Iglésies from UBS, who I will introduce more formally in a couple of minutes. But I wanted to show you, because this actually was from 2 days ago. And this is, I don't know if you're familiar with how a Bloomberg screen looks like. So this is not actually a very beautiful graph, but this is, if you look at Bloomberg mentions or Bloomberg LP, these are ESG mentions. It represents articles where ESG, again, environmental, social, and governance criteria were included, and you will see the very steep growth and the very steep, really record levels in April of this year. So really at the end of last month. If you compare actually ESG investment, and talking about ESG has gained momentum a lot in the last 2 years, there is a little drop during the initial part of the COVID crisis. But now that we're starting to talk about reopening some of the economies, especially here on this side of the world in Europe and in Asia too, not everywhere, because in some places you have a second wave, obviously. But there are a lot of questions about building a new normal and not actually going back to the same models of production. And you are going to see coalitions on greening the recovery. You know? So I hope you all are safe and healthy and taking the precautions. And I'm very happy to have the opportunity to share actually this webinar with you. So since we're going to start, I think the first thing is we're going to start talking today about sustainable investment. We talked a lot about impact investment, but we are going to go today more into the public market. So when we talk, I want to define, in case we have different levels of people, to make sure that we all understand what we're talking about. So when we talk about sustainable investment, we're talking about an investment strategy that incorporates environmental, social, and governance, and this is the ESG that I was mentioning before, consideration into the investment decisions. So we're really, when we talk about this type of investment decisions, we really want to know the impact that this criteria has in your portfolio, for better or for worse. You know? So really, when we talk about sustainable investment, we try to leverage the opportunities and mitigate the risk that the investments face. You know? So just to warm up, and hopefully you're up to getting a little personal. I think we're all very worried when we've seen the stock market volatility, and I don't know if you have seen your pension fund lately, but I have seen mine. So we might be worried about what is happening. And so I'm trying to share now my screen. Sorry, somehow my screen froze. Here I am. Okay. So we're going to do a little poll. Here we are. So here you have the criteria. So let's get you participating, and let's see what you think. So think very personal, think and be truthful. So would you like your retirement, your pension fund to be used or sustainable investment strategy? And I will open the poll right now. Option 1, as you've seen, is no, sustainable investment doesn't belong in my portfolio. I do my impactful decisions or investing or in philanthropic way or in different places. Yes, but not if it sacrifices returns. Yes, even if it sacrifices return is 3, 4, yes, but because I know that in long term, and hopefully you are not, if you're not retiring now, you expect that the return will be there in the future. And our pension fund already has a strategy like this, and I don't know yet, I don't have an opinion. So here you have the results. And I think most of you, 57%, actually say yes, because you expect to enhance the returns in the long term. Let's see what Jaume tells us about his clients too. And I would say the second one that we have is yes, but not if it sacrifices returns. So I'm fine, but as long as I don't have to sacrifice returns. And we're going to see that part of really this discussion is happening and in sustainable finance on how we are building and how different companies are really building the case for investing or ESG investment or values-based investment. So if you were in the previous webinars, you have seen already a little bit the framework. We were, until last webinar, we talked about the red area of this, and we talked about impact investing. Today, we are going to start it, as I told you, with private vehicles. Now we're going to go to public markets. So what we're going to focus today is actually on this blue line of the spectrum, where we have return, we actually seek market risk-adjusted returns. So at the same time, as I just mentioned, when we go from responsible investing and not traditional investment and sustainable investment and even thematic investment, we are trying to mitigate ESG risk. And I think after this crisis, we're realizing that even tail risks of a pandemic, or I think hopefully we will have a different perception about the climate crisis, how much value destruction they can make actually if they have very low probability. So how this systemic risk can be included and how ESG criteria can give us information about that. But also, not only, and this was part of the responsible investment group that actually work a lot on exclusions and sin industries, etc., but also about ESG opportunities. Now, how can we go into those companies that are going to drive that long term that you expect that will get returns? So if you think about the motivation, I would say between the difference between responsible investing and sustainable investment, and if you think more thematic, we're going to have some webinar on thematic investment. In the first one, you have more compliance and you want to behave responsibly, so you avoid certain things, and now can be pretty extensive. And we're talking a lot about decarbonization of portfolios and coal, and not just the traditional sin industries like tobacco or guns, etc. We are talking, when we talk about sustainable investment, it's really, I want businesses to have a positive effect on the world and society. So I want to look at the long-term performance. That is a little bit what you mentioned. And when we go into thematic, and we'll have a future webinar on that, is I want to help tackle a very specific change, and what we're going to see. And many of these things is what we actually call the impact economy, and we hopefully have a speaker that will talk about that. I'm talking this Friday, and we'll see what happens. So these are the next two webinars. We are going to talk about the COVID crisis and this idea of business transformation, and later we have deploying private capital for environmental goals. So we'll see thematic investment. So let me now take a minute to formally introduce Jaume Iglésies. And Jaume is the head of UBS Wealth Management Sustainable Investing Advisory. He's been with UBS more than 15 years in different positions in ESG and sustainability. And it's very interesting to actually talk to him, because you can see how in the last 15 years, ESG has been gone from a niche part of an organization to a very transversal type of criteria used in all kind of asset classes, I would say. So, and he's now advising clients on investment solutions that consider ESG criteria along with financial returns. So really, he's at the heart of this idea of how can wealth deliver not only financial returns, but also further impactful solutions. So before joining UBS, before joining UBS, he was at Deutsche Bank, where he was the head of investment and product management. And he's also a lecturer in several top universities, and I have a views of his goodwill in several of my courses and programs as a speaker, as a lecturer, and today in this webinar. So thank you so much, Jaume, for being here. And I want to ask you the first kickoff question. Now, I defined it minutes ago what sustainable investment is, but what does value-based investment mean? So is this an attractive value proposition for your high wealth clients? What is the market size, or what do you think about it?
So good morning all. Let me start by saying that I love you guys. I mean, the answers on the poll, I mean, that would make my life so much easier every day. It shows how advanced in the thinking this group is. And it does not respond to the average client yet. But as Vanina was saying, I mean, we've seen a huge difference. I mean, a huge jump just in the last 10 years. And I would say more specifically in the last 3 years, from being I wouldn't call it marginal, but not really at the center of finance, and now ESG being all over the place, really all over the place, and being one of the top efforts, for example, in the institution I work for. So the sustainable investing, values-based investing has different names, but I would say the punchline for us is that it needs to generate more than financial performance. So financial performance is absolutely necessary for our clients. I mean, no surprise. I mean, that's the future of their families, the future of their pensions, the future of their companies. Yet, at the same time, there's a growing number of clients that say, I need those returns, but I just want to get them alongside certain values or certain considerations that for me are important, be it climate change, be it gender inequality, be it social inequality. And sustainable investing tries to give an answer to those clients that say yes to returns, but also yes to integrating things which are really important to me in the way those returns are generated. Now, the question that we see, or that we try to deal with on the next slide, is how big that market actually is. And sustainable investing, it's certainly not a niche market anymore. If we look at the size of sustainable investing against the overall market, it's quite sizable already. So this is around 1/3 of all investments they are managed alongside certain sustainability criteria. Some might be extremely loose and light. For example, some fund managers saying, I'm not investing in controversial weapons. And as a result of that, they already qualify as sustainable investing, to very, very engaged fund managers or investors that really go really, really deep down and really try to make a difference. So you see that the variety is really big, but important is that the amount of assets is growing every year, every single year. And if we move to the next slide, what we see is also a reflection of that in the number of signatories of the PRI, the Principles for Responsible Investments, where we see that this is constantly growing. So, and now what we also observe is that when we get requests for proposals from large institutions, from family offices, it's almost a standard thing. They're asking you whether sustainable investing is part of what you do, how you do it, how credible you are, what's your track record, how many people you have in the team. So all these kind of questions that you see them, or you used to see them just very rarely, like 10 years ago, now almost became standard. And in some countries, Western European countries, is almost, you don't get around a request for proposal from a large investor without addressing those topics.
So you advise clients on precisely how to integrate this criteria into their portfolios, and how wealth can address impact, not only financial returns. Obviously, you need the financial returns, but how do you introduce this concept of sustainable investment, and what do your clients think about it?
I think that, as you mentioned, I think it was interesting that the first slide that you mentioned, because it just shows the attention that this topic is getting. I mean, and it's not from tree huggers. It's just that the core financial industry is looking at that.
Bloomberg,
And it's basically, yeah, exactly. And it's looking at that because the social pressure, and also because there's kind of acknowledgement that these intangible factors actually they can contribute to performance, and that they give you better insights on what a company is doing. The market has grown a lot, as we said, but I believe that we're only seeing a small fraction of what this market will become. That's just my personal belief. And despite the growth, there's still big potential. And the biggest hurdle, I would say, at this stage to realize that full potential, or how could we unlock as an industry that full potential, one of the things that we need to get our heads around and get better is education from the relationship managers, from the client advisors, because some of them like the topic, but some they don't feel at ease with the topic. And if you don't understand, you don't feel at ease, you don't see what the financial implications of that might be, you will hardly just pass that on to your clients. You will hardly start a conversation with your clients. So I think the industry has come a long way, but there's much work to be done yet on client advisor relationship managers training. Mm-hmm. Now, on the slide here in front of you, what you see is what we have observed over the last few years on different surveys we have done with our clients, and some of them comprise thousands of clients, and try to categorize clients in 3 different buckets when we try to understand how they react to sustainable investing. And then on the left-hand side, you see this bucket of clients, 10, 5, 15, kind of, that call it not interested. And it's like, yeah, climate change is a fad, this, that not exist. Perfect. It's a very valid opinion. That's a part of our clients that will never invest sustainably. To the contrary, we have on the right-hand side, those clients that I call them the yes, finally. And I call them the yes, finally, because that was a quote that I got from a client that she told me exactly that. Yes, finally, someone from a bank talking about something meaningful to me. Right? And this is a growing part or section of the clients. And probably it's 15, 20, 25%, depending on the countries. But these are really the people who that's very important to me. In between, you have these yellow, orange clients that I call them the why not clients. They are open to SI, to sustainable investing. If there are 3 conditions, or based on my experience, there are 3 conditions that need to be fulfilled so that these clients feel engaged. The first one is that they need to see that performance is at least as good as with conventional investing. Fair enough, right? So there's still the misconception among many clients that sustainable investing is a great thing, but it's kind of a UNICEF plus, it's here to save the world, but look, this is investment. So we're talking about something serious, right? Still in the kind of old-fashioned way of thinking. But many clients are realizing that that's not the case. That's going on in the world, be it climate change, be it gender, be it regulation, be it emergence of new consumption patterns, healthy lifestyles, corporate governance, absence of scandals. There's so many different factors that influence companies that might actually be a good idea to consider them. But the first thing is I need to understand that financial returns are going to be there. The second one is I'm not really ready to pay more for that. And the third one is, guys, make it easy for me. So if my client advisor, my relationship manager tells me how to do it and it's easy, I understand it, I see performance is there, are you not going to extra charge me? Then what we have all of a sudden is 3/4 of a standard client advisor's book are open to SI. And this is a huge opportunity because if they are open to SI and if you're the first one to go and talk about it, chances are that you're going to get that client. You're going to get share of wallet, you're going to get top-ups, you're going to attract prospects from other banks that haven't really started speaking that language with your clients. So that's the size of opportunity. What we're saying is that in an average client advisor's book, 3 out of 4 are open to have that discussion. Unless you're having that discussion, someone else will have it sooner or later. And if you're having that discussion, and in my case, it's my client advisors from UBS, the message to them is have that discussion, because if you have that discussion now, maybe JP Morgan is not having it, maybe Credit Suisse is not having it, maybe Julius Baer is not having it. So there's an opportunity for you guys, and luckily we're taking advantage of that market opportunity and being.
I have two questions that I want to bind a little bit on this return side, and I know you're going to give examples later on of different sustainable portfolio or different different things, but and when it comes from an anonymous attendee, so but I will tell you anyway. So, and one from Han. So I will bound these two. Do we have robust evidence of short-term returns going hand in hand with sustainable investment? And I know you will give some 6 to 18 months horizons, or are they still at odds? No, can we see long-term returns and ESG are getting more aligned as shareholders seek returns now and still be investment on ESG? And then Han is asking, how does the current US administration that is really getting away from the Paris Agreement and the different trends affecting their sustainable investing and this expected market return? So do you see this as a negative trend or as a negative influence, or what do you expect? Are we seeing already not only long-term expectations of future returns but current returns?
So the bottom line, what we're always saying to our clients is return expectations of sustainable investing are going to be in line with conventional investing, right? So there's no reason to believe that it's going to be lower. As a matter of fact, experience, what it has shown is that they are actually a bit higher, right? If you take the last 30 years, when you compare the returns of the first social index against the Standard & Poor's 500, the social index has even outperformed around 50 pips on average every year, right? So companies that have good corporate governance, companies that have good risk management, companies that treat their employees properly, companies that have good client relationship, all these things, they seem to reward investors. Now, the big question is, will that happen in the future? We simply can't tell. Nobody can predict the future. My personal belief, but this is just a personal belief, is that what we're seeing happening in the world in terms of climate change doesn't seem that it's going to get any better soon, right? So most likely there's going to be more and more regulation coming to many different industries, energy, airlines, automotive, right? We see it in many different countries. It seems also that the people consume in terms of healthy lifestyles, for example, is changing. It seems that young people is getting this thing. It seems that corporate governance is getting bigger and bigger and more important. So I would say that the factors that have underpinned sustainable investing, they're getting even stronger or even more important. Now, how this will play out in the performance, nobody knows. My belief, at least what we can say, is that companies are giving bigger importance and bigger relevance to these factors. And it seems logical to think that that should help performance. I'll keep it to that.
And we'll see a little, yes. And if this is a growing trend, and this is, what is the specifics? There's another question there, and then I will keep going. But I think it's interesting. How do the fees, including retrocessions, says here, for sustainable investment compare to other investments, to brown investments? And if this demand increases, it's just the bank that will benefit? Will investors benefit too? And who is your target market?
Mm-hmm. I just can talk about UBS. That's the one that I know the most. I mean, we don't make any difference between sustainable and conventional products, so we applied exactly the same fees, because one of the goals is to help this industry transition. So we're telling the clients there's two different ways of investing. If you want to invest sustainably, it's not going to cost you more money. Despite that, it's a bit more expensive for us to manage because there's lots of more research involved and many other topics. But in terms of fees, it's exactly the same for the clients.
So how do you convince, what kind of arguments do you use when you talk to these clients, and what works or what doesn't work, both?
Yeah, I think historically what we have seen, I mean, my advantage is that I've been doing that for a number of years now. So that means that I've done all the possible mistakes. So I have learned. Based on my experience, is there's one very, very big temptation for us is to start a conversation, sustainable investing conversation, trying to create an emotional connection with your clients. That's a very easy thing to do, right? We're talking about climate change. That's the future of family. We're talking about gender equality. We're talking about the future of our 50% of the population, our daughters, our wives. We're talking about social inequality. I mean, it's so easy. Yet, this, in my view, this is the wrong way to start a conversation. Why? Because if you do that, you're going to end up having a super nice, almost intimate conversation with your client, yet they immediately going to put sustainable investing in the bucket of UNICEF plus, right? So once they put you in this bucket, it's almost impossible to have a discussion around risk, around returns, about diversification. My suggestion is always, when we talk to the relationship manager UBS, try to make the economic case, right? This is a sound investment strategy. It has its own merits. It has delivered good returns. There's reasons to believe that it will deliver good returns. Make the economic case. Then once the conversation keeps going, the additional benefits will unfold naturally. Clients will understand that investing in a company that emits less CO2 is better for society than investing in a company that, a coal company, or investing in a company that is making research on renewable energy is better than a company, a highly polluting oil company, or companies that treat their employees well. There's not only economic case, because that means innovation, retention, talent, but you don't have to mention that it's good for society. Everybody understands that. So make the economic case first, and the additional benefits will just almost unfold during the conversation naturally.
Good. Let me ask you one question here. It's a part of advising UBS clients. How does UBS assist work with fund managers on ESG aspirations or procedures? Do you do active engagement, or what kind of things, when you explain how this is done in practice, what are the key issues that you mention to your clients? Because obviously that's your specialty now. Yeah.
In terms of engagement specifically?
In terms of procedures, operations, ESG, it's a question from Karsten. No, so I'm thinking, is it just do invest in class? Do you have exclusions? Do you also engage talk to companies to transform? How do you work with your fund managers on that?
Mm-hmm. There's different levels, and maybe we can jump. Vanina, what do you think if we jump into the portfolio example? Yeah, because that's exactly, just tries to address this point.
I can perfectly jump. Go to the first one, to the example now. Yeah.
Yeah. So there's different approaches, and the easiest approach is to start a conversation with the client by saying, well, why if instead of investing in corporate bonds, how about investing one part of that in green bonds, for example, right? So green bonds, you support companies that have an environmental agenda, for example, right? So you sit on the right hand side of this circle. For example, that's an hypothetical portfolio. 10% of the portfolio can be invested in green bonds, for example. Or if you go to the top of on the right hand side, you'll see the World Bank bonds. So instead of investing in U.S. Treasuries, for example, as most of the investors do, why not putting your money diversifying into World Bank bonds that are going to give you actually even a yield pickup? They are AAA. They never defaulted in the last 70 years, and your money is going to go to developing countries in projects like malaria prevention, or now with the corona, the World Bank just released 14 billion to train frontline health workers or monitoring diseases. And financially, it's actually the same, because you're even having this high yield pickup, as I mentioned, and it's a AAA, so it seems a good investment, right? If you go to the left-hand side on the top, the engagement strategy. So instead of investing in any company, why not investing through fund managers that what they do is engage with companies? So that go to these companies and say, hey guys, we like your company. We think it's a good, sensible investment, yet we believe that you should get better at whatever, CO2 emissions, gender equality, plastics, pollution, whatever the dimensions that might be. And we're going to help you to get these things better over time. So we're going to give you 2, 3, 4 years so that you can improve the way your company works. And that's a very nice way of collaborating for our investors, for example.
And I'm actually seeing in a lot of IMD clients and a lot of people that are approaching me right now that they're starting to get this investors conversation, and they want to know how to do that, because before they had like the CSR department that was talking more to external stakeholders, to NGOs, but they were not used to talk or report on these kind of things to investors. So I do think that this is starting to affect how corporates behave. We have a kind of a funny question from a person there saying, do you think we can convince German companies that are ruining the environment to actually change? No, but I think it is starting to happen, and I can see it in our practice at IMD a lot. You actually had you had a very provocative picture that I want to share with our audience. Oops, sorry, I think I should have stopped sharing here. So can you tell us why you think Quakers are the first responsible investors? And
okay.
I love that.
That's more. That's more the fairy tale. Yeah, that belongs more to the fairy tale. Because we like stories, right? So when we talk in front of large audiences, we're human beings. We like stories and we remember stories. So I just use that, and maybe it's a bit stretch, but still, I mean, it's still true and still like it. So the thing is that sustainable investing for many investors are like, wow, this is new. Yeah, sounds good, but this is so new, let's give it a few years and then I might return. And then say, well, sustainable investing was already born more than 200 years ago. It's nothing new. You might have not heard about it, but it has a long story. And these guys were the Christian that moved from the UK to the US and say, I don't want my money to be supporting companies that have slavery or pornography or alcohol or tobacco or whatever it is. So at the beginning, it was just excluding. Then as the time passed by, the interesting thing is that sustainable investing has come a long way, it has transformed. And then if we sit on the next slide, sustainable investing, now the way I see it is just kind of a proxy for a well-run company, right? So what we're trying to do is we're trying to get good insights on how a company works. And if you talk to an entrepreneur, and all entrepreneurs get that, all of them, no exception, is like, when you talk to an entrepreneur, you ask him, so how much time do you invest in having the best possible employees? And these family companies, they will tell you, we're very proud if someone starts in our company and retires like 50 years later. That's that's the best thing that can happen to us. We really spend lots of time and money to retain the talent. Now, this very same person that tells you that it's so important to retain talent, to attract talent, because that's what makes a difference. When this very same person has some savings and go to the financial markets, invest in companies, and spends no single second in understanding whether the company that he or she is investing, it's actually having motivated employees, right? And motivated employees is a proxy for performance of a company, obviously, right? So if I give you two choices, you want to invest in companies that have motivated employees or demotivated employees. Everybody will say motivated employees. Now the question is, how do we know which are the companies that are motivated, the employees that are motivated? And then we use few proxies like diversity. I mean, if you work in a company where people are systematically discriminated, it's unlikely that company is going to have really motivated employees. If there's lots of casualties in those factories, unlikely. If there's no training, or just use the opposite concept, if you invest lots of in human capital building, in good training, in good working conditions, in diversity, in pay people properly, then chances are that company is going to have motivated employees, right? Same thing with corporate governance. If you look at the explosions that we had in the stock exchange, from Volkswagen to BP to, you name these cases, almost always there's a bad corporate governance behind. Now, does sustainable investing know which is the next company that's going to have an explosion? No, we don't. We have no crystal ball. What we think, though, is that if we take all these factors into consideration, we have better chances to understand what's going to be the future of a company. So if we look into how strong corporate governance is, how strong risk management, what is the anti-corruption policies, what is the independence of the board members? They are not there just because they are friends of, but really because they have strong expertise in that field. They can counterbalance the role of the general management. All these things should lead into absence of scandals, better reputation, no fines, keep the license to operate, which is financially good, right? Same thing with clients. What you want to have is clients that like your company because the products are good, they're quality products. Think about sectors like pharmacy, chemicals, automobile, quality, security, they are of utmost importance. So all in all, sustainability, in our view, it's not rocket science, it's just common sense, long-term management, if you want.
And I think we have seen very well now during the COVID crisis how all these issues became extremely important. Now, how you treated your workers and worker safety, and also the reactions on corporate governance and CEO payments. So I think it was an extreme case to see how companies fare better or worse during this crisis. I left without realizing, and now it popped up with 10 votes. A question from Robert Kwok, and he's actually asking, what is the usual range of required return for a client in sustainable investment? So what's investing? What is usually the return?
No difference with conventional investing. Mm-hmm. So 99% of the clients, they expect the same returns. And then every client is different. It depends on the region, depends on the asset class. But just to make it up, if a client is expecting a 4% average return on conventional, our message is you should expect 4% on sustainable investing. So think about sustainable investing with the same risk, same return, and then hopefully over time, because of all these factors that we mentioned before, that will help performance. But we don't have different capital market assumptions for sustainable investing.
Good. And I think you had a slide here, and we have seen now a lot of reports. I know there are correlations, no causation, and very few data for now, that some companies that are good at ESG or good in that are faring better the current crisis. And there is a lot of research actually from the global financial crisis in 2009. No? So you provided this graph if you want to comment a little bit, because I think it goes to the risk return that you were mentioning. No?
Yeah, exactly. This is the longest, so it's 30 years old, 30 years track record, which is enough. I mean, we had very good and very bad moments over the markets. And this is comparing the KLD 400 social index, which is the first sustainable investing index, against Standard & Poor's 500. And what you see is that they go hand in hand. I mean, there's no significant difference. Yet, if there's one, is that the social index has been performing slightly better over 30 years. And the social index, what it has is listed companies. If you want conventional companies, and out of those conventional companies, it just selects the companies that have the best sustainability profile. That goes back to what we said: the best corporate governance, the best employees, the best conditions, situation, the best relationship with the clients. All these factors just seem to help to achieve overperformance, or at least in the past they have achieved overperformance. And then what we also observe is during this Corona crisis, the performance of the SI instruments on average has been better than conventional investing. Yet it's very difficult to make a case for such a very short time, and we really need to wait until this crisis is over. Yeah. What we can say is that there's no reason to believe that SI are going to just be worse in terms of performance, because historically they actually been slightly better. Although our statement is always they're going to be similar performance.
Can you give us additional examples? I know you have an ETF and an SRI, and because we show one, and I think we could show because we have a lot of questions about examples now. If you want to share with us.
Yeah. I brought this along because this is public information, so there's no problem here. So these are publicly available products, and so we just want to make clear we're not making any promotion here, just as an example of ETFs. So available products. And the beauty of that is it gives us a comparison between a conventional benchmark, for example, MSCI World against MSCI World Social Responsible, or MSCI Japan against MSCI Social Responsible, or MSCI Switzerland against MSCI Social Responsible. So you have all the different benchmarks, the different regions. And what you see for the last 5 years, the return on average per year, sustainable investing has been, in the large majority of cases, I think it's 7 out of 9 regions, sustainable investing has been better than conventional. There's one which has been almost equal, and there's one that's been worse. Again, we don't know what the future will bring, but we can say that historically, there's no reason to believe that sustainable investing underperforms. As a matter of fact, in these instruments, which are publicly available, listed, daily quoted, performance has been really nice.
And there's a lot of questions on how is it measured and what kind of things of measurements you use. And there is also one about big corporations and, for example, like large like Danone or Natura, or Patagonia. Do you see any positive effect of the big corp into the investment decisions or what clients ask you? And what kind of measures do you use? I know UBS has a proprietary formula to make the decisions, but there are a couple of questions on that, if you can briefly mention.
Yeah, so the idea is just try to understand many of these sustainability dimensions. So for each company, there's like 100 different data points. So that go from a car company could be how much CO2, how much NOx they are emitting, how they're recycling their products, for example. On the social space, how many casualties they have in their factories, discrimination, living wages, trainings. On the corporate governance would be board, management pay, say on pay, independence of audit committees, risk management. So there's a variety. And what we try to do is take that from external data providers, ESG data providers, apply our own proprietary methodology to translate that wealth of data into something that it's easy to manage for our portfolio managers and also for our clients. So at the end of the day, this is signal, like a score or a kind of a traffic light kind of thing that allows you to say, well, this is a good company, this is a bad company. Because the question is, how do I compare a mining company in Chile against, a chemical company in Thailand? It's almost impossible, right? So someone needs to do that work for an investor. And that's the role of, that's part of our role, to make it comparable and to be able to build up portfolios that consider all these factors.
We have shared some other webinars, and there's something we're also doing research, and sometimes how you lead on ESG performance, but also on material issues, and how you look at companies that really do ESG on material issues and to the core business. There is also a question, I don't know if you deal with emerging markets, but I think I lost it now, but the ETF from emerging market is lower than for advanced economies. If you know why, or how do you see, I would say in general, ESG investing in emerging markets? Is there a difference? Is all this increase only happening in Europe, US, or developed markets?
Yeah, so it's happening everywhere, but there's very different degrees of adaptation. So in Europe, you have the Nordics, Switzerland, Germany at the forefront, Netherlands, then the rest of Europe. Then it comes some Asian countries, then it comes the US, and then the emerging markets. Now, in theory, ESG in emerging markets is where it makes most sense, right? Because investing ESG in Switzerland, it's a great thing. But the delta between a company that gets a good ESG rating and an average Swiss company, it's going to be smaller than in the emerging market, just because in Switzerland, because out of regulation, public pressure, it's not that a company can start polluting, the lakes. That could hardly happen. While in the emerging markets, those things still happen. So the delta that you can, or how much leverage you can take out of ESG, in theory, should be bigger in the emerging markets. Also, when we do engagement, we like to do engagement more in the emerging markets, because if you want to engage with Apple, good, there's a long list of companies that want to engage with Apple. While if you go to a small medium company in emerging economy, you can influence that company much more, because they're going to listen. They might not have all the resources that Apple has, so the bang for your buck is much higher in emerging markets. Having said that, how this translates into an ESG portfolio in the emerging markets, then the thing is that there's lots of other things happening. For example, volatility in emerging markets is much bigger. Then ESG filters make two buckets which are much more different, so the good from the bad companies, and that means that the dispersion of performance in your portfolios there is much bigger. So that probably explains why this emerging markets ESG is not performing as well as the other ones. But I always take a word of caution with performance, because that might change in 2 years and we might see a different story, right? So I don't like to infer just strong conclusions on performance.
So with Patrick, we'll get back to you, because some research we have in the back burner, but we are starting very soon, is precisely on how the rankings are, how ESG in emerging markets is measured. So I think there is also a measuring on MSCI, etc., for emerging markets that can matter. But I think it's a very interesting issue. We have a couple of other questions, but I don't know if you want to go to you had another example, so because I think it is good to show, and I think you share with us this additional example, and then I will see if I have a couple of more questions. Yes.
Yeah, that's the methodology. Yeah, that might be a bit technical, but just here want to illustrate that.
Because a lot of people talked about the exclusions and the methodology, so just to tell a little bit how it works. Yeah. Sure.
So the idea here is, how are these MSCI ESG index constructed? And the first one is that you see on the step one on the left-hand side, the light green. So there's some exclusions happening. So we get rid of the classic suspects, so to speak, right? So the thermal coal, pornography, alcohol, tobacco, gambling. So those industries, they are out. The second step is that, and that just only speaks for what a company does. I mean, if it's alcohol company, it's out. It might be a very sustainable company, but there's exclusions work like this. They are very binary. Then the second step is what we call positive screening. So based on this ESG ratings, there's a minimum kind of threshold that we establish, and needs to be a rating of A. So from AAA to CCC, only companies in principle that are AAA, AA, and A make it. And then for each sector, we just take 25%, the top 25% of each sector from the ESG perspective. So that means that only the companies in each sector that belong to this top 25% from the sustainability perspective make it to the index. And then the last one is that there's some controversies. So companies that have very high controversies, they're also excluded from the index. And that's how the index is constructed. So it's a passive, way of investing, yet it has many more rules to guarantee that sustainability is adhered to.
Good. And the last example I think you provide to us, if you want to, I think these are the rankings actually, the scoring.
Yeah, so for the different types of ESG indices, for example, I just marked here the carbon emissions. So you see exactly here on the orange, these circles, that the MSCI wall on the left-hand side, if it's 100% emissions, if you move to the right-hand side, which is the product that we just saw, we call it SRI 5%. We have managed to reduce the carbon emissions to half, so 51%. So it's that you get similar performance. In this case, the performance has been better, but also you manage to invest in companies that emit only half of the CO2 than the conventional index.
Good. So since we are on the midst of the COVID crisis, has the Corona crisis affected sustainable investment, and how, and what kind of things you can mention about it?
Yeah. So I think there's a couple of dimensions. The first one is that we said the interest of sustainable investing has been growing constantly, but since COVID, you see that there's something changing in the mindset of investors and people in societies. Let's see for how long, maybe just short-lived, we don't know, but in reality, the attention that SI got just went to the roof. That's the first one. The second one is that luckily, performance against conventional investing during this COVID period, since February 21st, something like that, has been much better. Again, we don't know what's going to happen in the future. I'll have to repeat that 30 times, but
you have it in a disclaimer in the PowerPoint.
Yeah, exactly. You see that I'm used to speak in front of lawyers.
Yeah.
But so far, I mean, people are saying, wow. And the third thing is that there's this notion of people saying, is there anything I can do with my investments to help mitigate this tragedy, this problem that we're facing, right? And then is when we start making connections between what SI does and the pandemics, because preventing pandemics has not been the core thing of what our core mission. Yet there's so many overlaps. And if you look at the time frame before a pandemic starts, for example, one of the important things what we have learned is that, well, we knew, but what it's been reminded is that as many of the practices, agricultural practices, this claiming land and land and land, what we do is we get closer to this virus. I mean, this virus has always been there. It's just that now we're getting much closer because we're now where they used to be or where they are, right? And then the propagation gets much easier. So the question is there a way of doing agriculture business without having to claim more and more land as if there would be no tomorrow? And for example, one of the things that engagement does is trying to engage with companies, for example, rubber companies, that one of the companies that we're familiar with, that they're trying to work with deforestation-free rubber suppliers. Mm-hmm. And that's a concrete example.
Our previous webinar was all precisely on deforestation rubber suppliers.
Okay, then perfect.
Interesting financing these solutions. Very good. If you, sorry, yes, keep going. I think interrupted.
Yeah. Well, the other thing is, that's before the pandemic starts, but also when the pandemic starts, what we're seeing now is very interesting evidence from Harvard, for example, but there's a number of universities publishing research saying, guys, there's something that seems to connect pollution and COVID, right? So in Milano, in Madrid, in New York, these highly polluted cities, the death rate, seems to be higher. So it seems that there's a connection. And so SI, Sustainable Investing, is trying to play a role there. So there's an overlap. Then also when the pandemic spreads and starts affecting people's health, Sustainable Investing, what it does is investing in companies that try to provide healthcare systems and drugs to treat that. But even when the pandemic starts affecting developing countries, so investing in multilateral development banks like the World Bank, like the African Development Bank, that they are all AAA, seems to be a good idea, because the World Bank put 14 billion at the disposal of these countries. The African Development Bank just 3 billion, for example. That seems to be a reasonable thing. And then after the pandemic, whenever this happens, it seems that the pandemic has kind of boosted some megatrends that were already there, but now, like e-commerce, like health tech, genetic therapies, all these things seem reasonable to believe that they're even going to get stronger than they used to be. And sustainable investing has been investing heavily on those too. So it's not that sustainable investing is the silver bullet, not at all, but it's one of the additional elements that we can use in order to get things slightly better, right? And this slide is just it's coming from the FT, and you see it on the left-hand side, the evolution of the ETFs generally in the market over the last couple of weeks, the conventional ETFs that just got really a massive hit since the crisis started against the ESG ETFs, and they keep going up, right? So that since the market interest is there.
Good. So we are almost out of time. I have tons of other questions that I would love to address. So I will hopefully do another one later on. But any takeaways, anything you want to summarize for our audience as a closing? No.
I would say, well, thanks for the answers at the beginning of the poll. They were very encouraging. That's the first thing. But I think sustainable investing is here to stay. And I think there's this growing notion that people, or what I sense in my conversations every day with clients, is that people want to give their wealth a sense of purpose, right? They need returns, but there's this notion growing as we speak that my money needs to generate more than just financial returns. And now we have the instruments in the financial markets to try to get there. As I said, it's not the silver bullet. We don't have all the answers. It's part of a much larger movement. We can do certain things. There's things that where we don't get. I mean, we can't change everything. But I think it's a journey where we are learning. But I think it's a reasonable journey, I believe.
Great. Thank you very much, Jaume. And I think this is precisely the aim of these webinars on how can we mobilize private capital to spark social innovation and a transformation of solutions that are profitable or at the time impactful on society and the environment. And we all have the feeling and kind of know that after the COVID crisis, corporate investors cannot stand still and the world will not be the same, and that the new generations are pushing. I have teenagers at home, and I see that it's not only Greta pushing for a change on our behavior as consumers, and in the same also as corporates, no? So we really don't know, and really how we will confront probably the recession that will come after and the economic crisis that we see forthcoming as investors, corporates, or workers. But we see again that ESG challenges are going to be here to stay, and that might be, and that I truly believe that they are part of the solution on how we address and collaboratively how we find solutions to these grand challenges. So I think this is part of the ELEA Center for Social Innovation, and I invite you, all of you that so generously are joining me on these webinars, to contact me or to contact us at IMD, because it's part of IMD mission that we say we challenge what it is and inspire what it could be. And we really want to keep the conversation going. And as you know, we will have more webinars coming in the following week. So I think the best way to contact probably Jaume, because I know there are a lot of questions that stay there on the board, will be through LinkedIn, so we don't bombard you. You can contact me on LinkedIn too, but let me share also, if I actually can, you also have my email, the ELEA Center email, and my email at IMD. So thank you very much. It's 12 noon here in Geneva. I hope you find the webinar interesting, and we are in touch. Thank you so much, Jaume. Stay safe.
Thanks to you.
And as usual, a very positive and enlightening, and you can count me as a partner in crime in your quest for mobilizing private capital for impact. So thank you so much.
Thanks to you.
Everybody.
Have a good day. Bye.
You too.